High-income earners are locked out of the best retirement account. If your modified adjusted gross income is too high, direct Roth contributions are prohibited. For 2024, single filers hit the ceiling at $161,000. Married couples filing jointly are blocked above $240,000. This forces tax-advantaged growth into traditional pre-tax accounts. Future withdrawals from these accounts are taxed as ordinary income. The Mega Backdoor Roth strategy completely bypasses these income restrictions. It uses a legal loophole within the employer-sponsored plan structure. This allows high earners to fund a Roth account with tens of thousands of dollars annually. We are talking about tax-free growth and tax-free withdrawals in retirement. This strategy is essential for maximizing tax efficiency. It converts taxable future income into immediate tax-free wealth accumulation. The Internal Revenue Service sets two primary limits for 401k plans. The first is the elective deferral limit for employee contributions. This limit is $23,000 for the year 2024. Employees aged 50 and older can contribute an additional catch-up amount. The second limit is the Section 415C cap. This cap restricts the total contributions from all sources combined. Total contributions include employee deferrals, employer matching funds, and after-tax contributions. For 2024, the total 415C limit is $69,000. This limit increases to $76,500 with catch-up contributions. The Mega Backdoor Roth strategy exploits the substantial difference between these two limits. It uses the remaining capacity up to the $69,000 ceiling. This gap is the precise mechanism for maximizing Roth funding. Implementing the Mega Backdoor Roth requires specific plan features. The employer's 401k plan must explicitly permit non-Roth after-tax contributions. These contributions use dollars already taxed by the employee. They are similar to Roth contributions but held in a separate 401k account bucket. The maximum after-tax contribution is calculated precisely. Subtract the elective deferral and the employer match from the 415C total limit. This remaining amount is the maximum after-tax contribution space. Crucially, any earnings generated on these after-tax contributions are taxable upon withdrawal. Immediate conversion to a Roth account is necessary to prevent this taxation. This conversion step ensures all growth remains tax-free forever. The conversion step transforms after-tax contributions into tax-free Roth assets. This conversion must happen immediately to minimize taxable earnings accumulation. The plan may allow an in-plan Roth conversion. This moves the funds directly into the Roth 401k portion. Alternatively, the funds can be rolled out of the 401k plan entirely. This is called an in-service distribution. The after-tax principal rolls tax-free directly into a Roth Individual Retirement Account. Any earnings accrued before the conversion must be handled differently. These earnings must be rolled into a traditional individual retirement account. Earnings rolled into a traditional individual retirement account remain pre-tax. They will be subject to ordinary income tax upon future withdrawal. The standard backdoor Roth Individual Retirement Account uses a different mechanism. It involves non-deductible contributions to a traditional individual retirement account. These funds are immediately converted into a Roth Individual Retirement Account. This strategy is limited by the annual individual retirement account contribution limit. That limit is $7,000 for 2024. The Mega Backdoor Roth utilizes the 401k structure instead. It uses the much higher 415C limit of $69,000. The standard backdoor Roth is subject to the Individual Retirement Account Pro-Rata rule. This applies if the taxpayer holds existing pre-tax traditional individual retirement account balances. The Mega Backdoor Roth is generally exempt from this rule. The conversion originates from a qualified employer plan, not a traditional individual retirement account. The Pro-Rata rule mandates proportional taxation on traditional individual retirement account conversions. Tax is based on the ratio of pre-tax to after-tax dollars across all non-Roth individual retirement accounts. High earners often have substantial pre-tax individual retirement account balances. This makes the standard backdoor Roth inefficient or highly taxable. The Mega Backdoor Roth avoids this complication entirely. It converts funds directly from the 401k plan structure. If a rollover is used, only the earnings portion of the after-tax contribution is affected. These earnings are rolled into a traditional individual retirement account. The after-tax principal rolls tax-free into the Roth Individual Retirement Account. Any earnings accrued before the conversion must be handled differently. These earnings must be rolled into a traditional individual retirement account. Earnings rolled into a traditional individual retirement account remain pre-tax. They will be subject to ordinary income tax upon future withdrawal. The standard backdoor Roth Individual Retirement Account uses a different mechanism. It involves non-deductible contributions to a traditional individual retirement account. These funds are immediately converted into a Roth Individual Retirement Account. This strategy is limited by the annual individual retirement account contribution limit. That limit is $7,000 for 2024. The Mega Backdoor Roth utilizes the 401k structure instead. It uses the much higher 415c limit of $69,000. The standard backdoor Roth is subject to the Individual Retirement Account Pro-Rata rule. This applies if the taxpayer holds existing pre-tax traditional individual retirement account balances. The Mega Backdoor Roth is generally exempt from this rule. The conversion originates from a qualified employer plan, not a traditional individual retirement account. The Pro-Rata rule mandates proportional taxation on traditional individual retirement account conversions. Tax is based on the ratio of pre-tax to after-tax dollars across all non-Roth individual retirement accounts. High earners often have substantial pre-tax individual retirement account balances. This makes the standard backdoor Roth inefficient or highly taxable. The Mega Backdoor Roth avoids this complication entirely. It converts funds directly from the 401k plan structure. If a rollover is used, only the earnings portion of the after-tax contribution is affected. These earnings are rolled into a traditional individual retirement account. The after-tax principal rolls tax-free into the Roth Individual Retirement Account. This preserves the original tax basis without triggering the Pro-Rata rule on the principal amount. The original Secure Act of 2019 did not restrict the Mega Backdoor Roth. However, the Secure Act 2.0 of 2022 introduced new conversion rules. Effective January 1, 2024, certain conversions are restricted. All employer matching contributions converted to Roth must be taxed immediately. Deductible employee contributions converted to Roth are also taxed immediately. Crucially, Secure Act 2.0 did not eliminate the core mechanism. The ability to convert after-tax non-Roth contributions remains intact. This conversion remains entirely tax-free. This is provided the conversion is executed immediately before any earnings accrue. The Mega Backdoor Roth strategy is still fully viable under current law. Implementation requires 3 specific steps. Step 1. Verify your 401k plan document. It must allow both after-tax contributions and in-service distributions or conversions. Step 2. Maximize your elective deferrals first. This is $23,000 in 2024. Calculate the remaining capacity up to the $69,000 415 limit. Step 3. Set up automatic after-tax contributions to fill that remaining capacity. Schedule immediate and frequent conversions, such as quarterly or monthly. This prevents the accumulation of taxable earnings. This strategy provides tax-free growth and tax-free withdrawals in retirement. It successfully bypasses all high earner income limits.